well, we are 50 already, like around 100 signed up, and it's always some decay there. So, well, I'll get started at least with the introduction. Well, first of all, thank you very much for joining. Of course, it's always like a pleasure and humbling, like to see people connecting to our events. So, as you guys may know, well, I will give a brief introduction on us in case you ended up here through someone else. So I'm Jaime. I am the CEO of the Startup CFO. What we do is fractional CFO services for startups, among many other services that relate to early stage startups. So, for example, in a company as fractional CFOs, we can take care from day one. Like if the startup is in pre-seed stage, we can already do like the first financial figures and support during the first fundraising and like the first admin setup. Then if the startup is already in a more advanced stage, maybe seed, we already start taking care of the whole like monthly reporting, monthly forecasting, meetings with investors, and any need they may have in the finance area. If they audit, if they have subsidiaries, if they have different currencies. I always say, like, if you had a CFO next to you, like all the things that he would say, please take care of this, those are the ones that we can take care of. And also, we can take care of public funding applications, which is very synergetic. And of course, also like from a startup, very first day until the startup is huge, they always apply to public funding. We also do bank funding, in case you want to put it on us, like, please talk to all the banks and get us bank funding. And also we do all accounting, tax, labor services on day-to-day basis, and even legal, corporate tax, and IP law. And also, well, again, very synergistic. Like many companies want us to be the lawyers for their first funding round, or to draft in their company agreements or shareholder agreements that we will talk about later, in fact. As I was mentioning, last year we opened our office in Berlin, growing healthily. So I'm happy to take on more clients from Germany, but we have served clients already in over 20 countries. So our offices are in Madrid and Berlin, team of 35 people, I think we are right now. But our primary focus are the Spanish and German markets, but we also operate, we can also take startups anywhere else. We have a lot of content similar to this webinar. And in fact, when we finish this webinar, we will upload it to YouTube, to our YouTube channel. In our YouTube channel, you can find many webinars similar to this on how to build a business plan, how to build the reporting, how to like pricing for startups. We have done really a lot of content. So I hope that it adds value, and we are very happy to share it. And then, as part of this sharing knowledge initiative, it's our Academy program. The very first edition of the Startup Academy was launched 3 years ago, September 2021, and we are about to launch the 11th edition, which starts next week. Well, next week we start giving access to the students to the platform and to all the materials, but it's 3 weeks later, the middle of October, when we are gonna start having the live sessions. So I'll explain a bit more of the dynamics. Well, if you guys go to either like our website, you guys can go like through 𝗧cfo.com and then like click on Academy up here, or you guys go directly to the startupacademy.site. You guys can find details on our course and dedication. In any case, as I was mentioning, like next Thursday is the presentation. 3 weeks later, the first live session. I'll give a little more detail about it at the end of the webinar. And in fact, if you guys sign up with the link that we're gonna share, you guys would have some discount in the course. So, to the topic of this webinar. Well, first of all, if you guys have any question, I prefer that you guys like cut me on the spot. I mean, obviously, if you want to wait for the end, that's totally fine. It's not illegal. But if you guys want to cut me straight, like in the middle of a sentence, like, hold on one second, I didn't understand that. Or in my case, X, Y, and Z, or whatever, certainly happy to stop and clarify anything. I always think that if anyone has a question and then like we derail a bit, it's much better than to continue in a path that people are not paying attention. So certainly happy to take any question. So I assume that if you guys came here to this webinar with the topic of understanding the first funding round, it's because you guys either haven't done it in the past, or you guys are planning on doing it soon, or you're supporting, or many times, by the way, the people that go to our academy course, for example, are people that are not in finance. Many times are even either early stage CEOs, or maybe even from other areas. We have had like technological people, product people, sales people, that they say the finance part can't be just a black box to me. So I'm going to assume that this is more or less what brought you here and the type of understanding that I assume on you guys. And if I were you, what I would like to know about raising a venture capital round. So we will start with key terms in deal execution. I always say that in startup finance is not that hard. That's why, in my opinion, you can do a 10-week course on startup finance and like get a pretty good view on it. But yeah, it has like a very, very, very specific vocabulary. So a startup is a company. That's it. And companies have some financials. That's it. And every single company in the world exists to return money to the shareholders. Fine. A startup meets all those requirements. But the type of situations and the type of tools and the type of goals are very different, or like the way to achieve those goals are very different than a standard company. So first, we're going to cover vocabulary and what it means and how all these terms relate. Nothing is more complicated here than to multiply numbers or to divide numbers, add them, subtract them. Nothing is more complicated than that. But you need to tie many numbers together and like really grasp what's happening in a cap table. Second, more on the and then I think like the later part is more on the process. The term sheet and the shareholders agreement are the key documents that run, like that essentially run like the fundraising process. And last, just a bit, I think like very bit, on the due diligence process. Like once a fund says, okay, I'm interested in you, they will start a due diligence. And how does this work? In any case, by the way, we always say that if this is the first time that you are playing with these concepts, of course, it's better to get some help. I mean, it's a bit like on the commercial side, but of course, this is why I think that we have a successful company, because I think people need help when tackling this complex problem for the first time, because they are risking a lot of their own money and of their own effort. So let's cut to the chase. Key terms in deal execution, core definitions that you need to grasp. So you probably have heard sentences like, whatever startup raises a 5 million euro Series A. My dad has worked in finance for 30 years and he wouldn't understand a word of this. Like raise what? Series A what? So in the end, what he would understand is this company makes a capital increase of 5 million euros. So it is just a capital increase. Public companies, huge companies, a huge bank can do a capital increase to finance a project or to finance losses or to finance working capital. What happens in a capital increase? New shares of the company are created at a certain price. That, of course, means that the people that have the new shares will have some economic and political rights. But simply is you create new shares for that certain money. In this X startup, imagine, maybe this startup has 10,000 shares, and then they just created 2,000 more shares for 5 million euros. 5 million euros get inside the company, and the people that put it keep 2,000 shares for them. So far, I think more or less it makes sense. Like you have like a bigger pie like people pay for that new piece of the pie, essentially. So this, you can say, well, but like now the founders have less, like have less in general, have less money, have less control. Yes, the founders used to have the 10,000 shares, and out of 10,000, all of them, and now they have 10,000 shares, they didn't move them, but of something that is 12,000 shares long. So they now have 83% of the company. So what's the business here? They have less percentage of the company. What the hell? They probably have less control over the company. Yes. And maybe these guys, besides the money, they asked for additional political rights. If that percentage got too low, and this is a very important concept, they are less motivated. If at some point the founders had 1%, and then a VC has 15%, and then another guy has 10% and whatever, then the founders could say like, okay, you run it. You are more worried about this than I am if the founders have too little percentage. This is very important. We'll talk about a healthy cap table later. Another way to see it is that the founders have more. Why is this? Because these 2,000 shares were given in exchange of 5 million euros. This means that each share is worth a lot of money. So the founders that have 10,000 shares, they are like, wow, now we have something that is worth, on paper, 25 million. And that's great. But the key here is on paper. So they have 83% of something that is worth 30 million. I think I'm making the numbers right. But maybe not. So that's why they have less percentage of something that is valued higher by the market. According to the market, their 10,000 shares are also valued for a lot of money. In fact, and this is a complication that I just want to mention because it is not common a situation in early stages, in the very first funding round, they could even sell part of their shares. Not like money that gets into the company, but to say, okay, I have 10,000 shares. Does anyone want 500 of my shares and pay me 1 million for them? Maybe the answer is yes. It's usually not the case in early stages. It's usually not the case in your first professional VC round. But maybe the second, and certainly starts happening, or very likely starts happening beyond them. Also, another answer is it depends. If it's a down round, like the new round has a lower valuation than the previous ones, then you have a smaller piece of a smaller pie. But the alternative maybe was to go bankrupt. So at least you have a pie. So funding rounds. Not all capital increases usually are considered like a funding round. If we're just saving the company, if it's like some agreement among shareholders and stuff, but it's not a substantial amount of money that gets in the company with an ambitious objective, we're not going to talk about them as funding rounds. So why is it like in milestones, in like big chunks, in like we're dedicating many months to get this many million? Because the effort to obtain private financing is huge. The quickest funding round I've ever seen is 4 months, and it was by 𝗀𝗀𝗀. 𝗀𝗀𝗀 was sold 3 months ago very successfully. So certainly here is like, okay, the best that I've seen was the best startup I've worked with, and they did 4 months. Even 8 months nowadays is not, I would say, the upper limit. The upper limit is a year or maybe even more. So you manage it simultaneously with several investors. It's exhausting, but at some point you are done. If you needed to do it just million by million rather than 5 million at the same time with several investors, you want to kill yourself. So how do you handle that? How do you handle several investors at the same time? Usually, the investor who puts more money will lead. It's usually called the lead investor, and you will negotiate to that guy, and the other guys will abide or not. They may want like to say their piece, but usually the guy that puts more money is the guy that leads the negotiation. I guess it makes sense. So also you want to raise money with the objective of 24 months. This 𝗧𝗪, by the way, 𝗧𝗪, the software that is specialized on controlling cap tables and like shareholders and stuff, they just released a very good piece of analysis. They always release very good pieces of analysis on the time between rounds. And now the average is almost 2 years. So you want to raise money that will let you achieve a very ambitious objective within the next 2 years. So the effort is huge. And here, a crucial point is the valuation, because I kept saying in my example that those 2,000 new shares, the investors put 5 million and they kept 2,000 shares out of 12,000. That's the example I made up on the spot. Okay, but maybe they could have paid 5 million for 3,000 shares or for 1,000 shares. And that changes things completely. So what is the key here? How much the company is worth? This is the valuation. The valuation, in my opinion, the easiest is to understand the post-money and then the pre-money, which is like the first name of the valuation that you need to put. Post-money valuation. This is very simple. Forget everything I said. If I transfer 1 million euros and I keep 10% of the company, how much is the company worth? 10 million. I think this is more or less self-explanatory. Like, it cost me 1 million to retain 10% of the company. Then the company is worth 10 million. The pre-money is, okay, so how much was that company worth in the minute before you transfer the 1 million? Well, 9 million. Because like a minute after is the same company, but with 1 million in the bank. So the pre-money valuation in that example would be 9 million. It's what the original shares are supposed to be worth. What the original company without the new money is supposed to be worth. This supposed to be worth is very important. I won't go long, and in fact, we have whole lessons on valuations. But people think that there's a definitive answer on like what's the valuation of this company. And they think that we're going to crunch their numbers, put them in a huge Excel file, run some code, and then give them a number even with cents. And no, at the end, it's a market thing. And it's the number that aligns the interest of everyone involved. So it can be misleading because like how it relates to the business terms, well, it's arguable. In the stock market, for example, you see the valuation all the time of a public company. You see what a share is worth, and therefore you can infer what the whole company is worth because people buy and sell all the time. But in a startup, that is every other year, that is huge uncertainty, that the numbers are not public. Well, who knows? So the valuation, let's just keep by now the technical term. And again, on valuations, we could talk a lot. Like, by the way, if you have questions later on, or if I forget to mention something, please, of course, you can ask me. The dilution is the bad news, is what I mentioned at the beginning. So if you maintain the number of shares in the company, but there are more and more shares, your percentage that you own in the company is lower. This doesn't mean you have less shares. You will only have less shares if you ever sell shares that you already have. But if you keep creating shares of the company, again, the total number of shares you have stay. But you just need to divide by so many more shares that you may have. So this is why the VCs usually invest a bit in the first time that they invest in your company, and they keep a lot of money in case they want to invest again. They invest maybe in 30 companies. As you guys know, in VCs, many of them go bankrupt or return little money, and they see that the others are doing well. So then they invest a lot of money in the ones that are going well because they don't want to get diluted. Because I'm speaking all the time about the founder's dilution because I put myself in your shoes and I understand that's your point of view. But you also need to realize that the VC that invests in the first round has some number of shares among some number of shares, and in the next round, new shares will be created. So they also get diluted. If they also participate in that new round, they have more shares to divide among more shares, but at least they don't get diluted that much. This is why also it's advisable for founders. It's always a very good sign if the investor, especially in the first funding round, sees that the founder is putting money on his own company. Of course, this will depend on the economic situation of each one. And that makes total sense. But if they invested their own money, they say it's because this guy thinks that the shares of his company are gonna be valued by a lot of money. And this guy now is in no way is like, I'm giving shares for free. Like, I'm willing to pay for my own shares now and have more shares now. You invest less money. So then, like, in the future, I will have a bigger share of a huge pie. That's always a very good sign to see that the founders put their own money, are risking something. And then the stupid thing is that the only real thing here, I always say this stupidly, but the only thing that goes to the notary is the number of shares and the price per share that you are creating in a funding round. The valuation, you guys will keep arguing about the valuation forever. This VC says that they will invest at 3 million valuation. Fine. This other VC says that they will invest 5 million, whatever. Then you guys will see later that this gets more complicated with SAFEs and convertible notes and phantom shares and stock options and all that stuff. But in the end, so then like the valuation will start having even more last names. No, but like the fully diluted valuation, fully diluted cap table. Or are we counting the stock options? Aren't we counting? Are we counting half of them like I once saw? This convertible note is supposed to convert after or before the fundraising. So, you know, then it will start getting complicated. So don't forget that the only thing that exists is that the people want to be happy with how much money they put in and how much percentage they have at the end. And the only thing that goes to the notary is, I'm putting this money for this number of shares. That's the only real thing. I know it sounds stupid by now. It will help later to keep the basic concept as the base. So many times they ask us, this is more on the accounting side. It's like, okay, I started the company with 3,000 euros just to incorporate it. If now someone invested 27,000 euros, I keep 10%. No, because they may pay 27,000 euros for 100 shares. So one part would be the capital and the other would be the premium they are paying. It's more on an accounting detail, but I've heard this question before with similar or different numbers many times. Another thing could be the rounding issues, and there's also like more nuances here. That's why something that we do very often, even in big clients that we are the CFOs, we are the ones that control the cap table and that model the cap table in the future funding rounds. It's not trivial at all. It's easier usually in the first round. It starts getting way less easy in time. Even lawyers count on us because we are the numbers guys on this. So several concepts: funding rounds, valuation, dilution, share value, that we will start seeing how it works in the cap table. In fact, I realize I've mentioned the cap table a couple of times without defining it, which is wrong. But here it is. The cap table is simply a list of all the shareholders of the company, each of them with the number of shares, and therefore, usually, the percentage of shares. In the example I keep saying, founders, 10,000 shares. Well, you would split it by person. Maybe founder, 10,000 shares. New investor, 2,000 shares. That's a cap table. Then you could do the percentages. One has 83%, the other one has 17%. Fine. That's it. So why the hell, if it's such a simple document, it is usually one of the 3 documents that VCs request for the very first call with a startup. They usually ask for the investment deck, the business plan, the numbers, and the cap table. Because a cap table must be healthy. And what does healthy mean in a cap table, in a document that is a list of people with a number of shares? Because the founders must have a reasonable percentage of the equity of the company. Again, this is super important. If you're going to your first VC round, you're going to ask for 500,000 and you have 30% of the shares, it's absolutely impossible that you get it. Absolutely impossible. Maybe other type of investors, fine, not a venture capital firm. Because a venture capital firm counts on you getting diluted more and more and more in time because you will want to accelerate your growth. So if you already have 30%, Once they invest, maybe you have 24. Once someone else invests, maybe you have 18. Once someone else invests, you have 10. And you start having less than your investors. So, and then like you start doing numbers, it's like, okay, even if everything goes well, which is kind of unlikely in startups, even if everything goes well, I'm gonna make maybe less than $1 million in the next 10 years, and that is if everything goes fine. So a VC doesn't invest in you for that. They want to see that you own most of it, that you left your old job. By the way, another question we receive very often. They want to see that you're betting everything on it, your money, your savings, your old job, you said goodbye, and that you have a huge percentage of the capital. And the success of this project would be like to solve your life financially forever. So that's what they want to see. Also, more on the healthy cap table, the interest of the new shareholders must be aligned with those of the old ones. So also this sometimes happens, and it's not the end of the world, like I will explain later. But it is not good to have many minority shareholders, or like if you have a corporate, if you have Telefónica with 30%, maybe a VC is going to invest and keep 15%, and maybe they are like, well, but Telefónica is going to push in a direction that I'm not going to push. The VC always wants a new funding round, and Telefónica will not want. Then we will have issues in the future. And if there are many minority shareholders, usually the whole family of the founder, this is very common. Also, it may happen that like a lot of people there are not related to the business, and if at some point they get angry, they could screw up the business. So a hostile shareholder can cause many problems, even if there are ways to minimize it. So having a ton of people in the cap table is not a good sign. We have seen it sometimes. We have seen it not being a total blocker, but always bringing up issues. Subtleties. I'm explaining more a funding round and what we would expect and everything fine. But there are usually more stuff. Many times there are secondary transactions. So you sell your own shares, or someone buys your shares without creating new shares. Usually just like to have like the news that are public is not information. It's not enough information to build the cap table. So in the end, in a funding round, the valuation, the dilution, everything that I was just saying are tools, because the only thing that exists is the share value. And it needs to be such, like the valuation is the tool to speak, but it needs to end up satisfying these 3 questions. Like any investor wants to know, does the management team have enough shares to be motivated and in the future will be able to raise new rounds? You say yes. Do I end up happy with the money I'm putting in or putting out if I'm selling? And the percentage I keep at the end of the funding round? Yes. Check. Does the company have enough money to achieve their business plan? Like if the first 2 are checks, but like then the company has 10,000 euros and they need to achieve a huge thing in 2 years. So as long as we agree on these 3 things, everyone is happy. And then the tool to get there is the valuation. Syndication, I'm going to go quickly here, but just if you guys are starting your first fundraising, if you guys have your whole family and your whole friends as investors, that's totally fine. But you should syndicate them with the CEO or to build a separate company from which they invest. So syndication means that they don't have effectively voting power. They would delegate it to you as the CEO. So it's like, okay, there's a dirty cap table, but at least they don't have any practical power. So how does a cap table look like? I wanted to show you a little example. This is fictional. We call it 𝗂𝗵 company, but it's based on a real startup. Several founders start with some shares, each of them, 150,000, 850,000, whatever. This number of shares. They maybe put 10,000 euros to build it. Then one of them invests more money. Then some business angels invest more money. The valuation is 700,000. I'm gonna go super quick, by the way. So we're thinking that each share is worth 65 cents. If you put 20,000, then you get 30,000 new shares. And then at the end of the day, the guy that put the 20,000 euros bought 31,000 shares at 65 cents each, keeps keeps a 31,000 shares among 1.1 million shares, 2.7%. And this will keep happening over and over again. Okay? I still haven't gone to the nuances, but let's just keep that general thought. By the way, this webinar that we're giving today in the academy course, I think is 3 lessons. So I'm going pretty fast on many things, and we don't have time for the practical cases and so on. By the way, of course, text me at the end of the webinar or whenever, or text us if you guys need any help, any doubt, or whatever. So another thing that you guys must have heard, and it's important, and it's an important tool to use, the stock options or phantom shares. I'm going to use them as if they were the same. And I'm going to make some mistakes deliberately because we cannot go in too much detail. Of course, in the course we do, here we don't have time. Phantom shares, in Spain it's much more common phantom shares. Out of Spain is more common stock options, although in Germany we have also seen virtual shares, which essentially is phantom shares, and so on. So it is simply a form of variable remuneration, like a bonus. That's it. And the phantom shares, and again, I'm deliberately not saying everything 100% accurate. The phantom shares are like, will make someone benefit from the success of the startup as if he was a shareholder. But it's not. Absolutely not. It's just a bonus. But we will calculate that bonus as if you had been a shareholder with X shares in the company. So why would we do this? First of all, because at the beginning of a startup, usually we cannot pay market salaries to the first employees. So what can you say is like, listen, man, you have 60,000 euro salary, and I can pay you only 40,000, but I'm gonna give you 2,000 phantom shares. This means that if we ever sell the company for a lot of money, that day you will receive the money as if you had the 2,000 shares. Again, as if you had. They are never shareholders. This is like where the start with the stock options may play a role, but in practical terms, that's how it works. Later stages, the key employees, like maybe you can pay market salaries, but the key employees, they still may say like, you know, like I've already been successful in 3 startups. You want to hire me? The salary is fine, but I'm already kind of rich from the previous successes. So like, give me 1% of the company in phantom shares. And then if we're truly successful, I'm going to make the big money here. That sounds pretty good. Also, in some companies, the CEO may want to motivate some employees or all of the employees with like, okay, if one day we get successful, we are all happy and we all throw a party. I'm personally a bit against of the giving to all employees. Then I'm a bit hypocritical because then I do it in my own company, although I don't think the situation is the same. But this could start a debate. I've seen it in many cases that they give to all employees. What is the impact to shareholders? Because here, like, we keep saying like, hey, don't worry, man. Like, if we ever sell the company, you will get money as if you were a shareholder. Then the real shareholder says like, hello, what about me? So yes, the real shareholder will get less profit once the company is sold. As simple as that, yes. So the CEO gave the phantom shares to someone, which will decrease the return to the shareholders. But the shareholders, if they're a bit smart, they will be happy with it. Why is this? Because they know that the company needed it to motivate the right talent and to keep the right talent. So usually what you do in a funding round is to limit the number of phantom shares that you can give, of course, because the CEO couldn't give like millions and then the shareholder wouldn't get anything in an exit, in a sale of the startup. But there's a limit, but they can give it, and the investors know that they will not receive all the money. So this is when 2 words that you guys may have heard or you will start hearing come into effect: non-diluted and fully diluted. The non-diluted cap table means that you don't count the phantom shares as if they didn't exist. You decided that there's a limit of 10% of phantom shares that you can give. If the company has 10,000 shares, the CEO can give away 1,000 phantom shares. Fine. now you are counting only at 10,000. And with the fully diluted, you are counting the other 1,000 too. So imagine you are an investor that owns 2,000 shares, non-diluted, maybe you have 20%, fully diluted, you have 18%, because the total number we're dividing it by is different. These are the two extremes that could happen in a liquidity event if the company is sold. So if none of the phantom shares have been given away or have vested, which is another important concept that I cannot go into, then it would be the extreme of the non-diluted. If all of the company's phantom shares have been given away and all of them have vested, then we would receive all of those shares would receive something. So we're talking about the fully diluted. What would happen in real life? That it's some of them, not all of them. So if the company is sold, you won't get 20%, you won't get 18%, but something in between. So sorry about that. Anyway, these sound not very important, but then when they tell you the valuation of your company and you agree that it's 2 million, then you need to divide. Like here, we were saying, imagine, like here, you say, the pre-money valuation is 10 million. And in order to know like how many shares the new investors are getting, you need to know the price per share. So you say, okay, we had 14 million shares, sorry, 1.5 million shares, and we're valuing them at 10 million. But here is where the argument can start. Counting or not counting the phantom shares. So this is why it's very important to know this type of last names. And by the way, in this type of like nuances, it may go 10% of your equity. 10% of your equity, if the company is sold by 15 million, it may be 1.5 million. I mean, of your equity, of the equity, I hope you got my point. It can be a lot of money. That's why there are arguments and arguments and arguments. And many times we negotiate on behalf of everyone to close the valuation and to close the deal and to calculate the final numbers. Another thing that complicates the story. Well, I see a question in the chat. Okay, it's a private question. Receive an offer to join a startup on a CEO position. Would you suggest equity or phantoms for a tax fiscal point of view? That's a good question. First of all, on tax and fiscal, it depends on the country completely. And I am not myself an expert. We do have experts. I am not myself an expert. But certainly equity. And especially in Spain that you just mentioned. Equity, certainly. Equity has better taxation. And phantom shares, again, I keep saying that the phantom shares are as if you were a shareholder, but you're not. What they will pay you is a bonus in your payroll, or there are other ways if you are no longer an employee, but it's a bonus and you will declare it as part of your income tax. It has some benefits up to 30,000 euros, up to 30%, sorry. Equity is always much better in taxation, but still, it depends on many things. So what else complicates the story? The safes or the convertible notes? By the way, I'm going pretty slow, so maybe I'll try to accelerate, but I hope that you guys are following. And thank you for the question. So safes or convertible notes, I'm going to do the same thing. Deliberately, I'm going to treat them as if they were the same thing, but they are not. So it's not 1000% correct what I'm going to say. What is a convertible loan? A loan that can be converted into equity. So usually a loan, you pay 1,000 and you expect that they will pay you back 1,050 euros. This, you don't expect 1,050 euros in cash, like to your account, but you expect that money into shares of the company. So when you're paying when you're giving a convertible loan, nobody expects it back. Nobody. I've never seen it. Usually, even if like the investor, well, the guy that gave the loan, wanted it back, the company doesn't have money and it would go bankrupt. I've never seen a convertible loan not ending up in shares. Convertible loan or convertible note is usually, I mean, it's synonyms. And by the way, I've seen loans that they weren't repaid in cash or in equity because the company went bankrupt. So convertible loans, the thing that they have is that they simplify negotiations for a couple of things. They don't define a specific valuation. They usually relate it to the next funding round, although with some limits. I don't know if yes, I'll explain it in the next one. But it simplifies the negotiations because the valuation is not set on stone yet. And second, because you can like just sign it over email. You don't need like the notary, you don't need like a whole thing because you are still not becoming a shareholder. So you can sign a convertible note with this guy, 1 week later with this other guy, 3 days later with this guy, and you start receiving money in the company. And that's great. That's a great advantage. They are very typical in very early stages that you get like this type of tickets, or in bridge rounds. What does a bridge round mean? Existing investors, usually existing, give you money to extend your runway until you close the next fundraising. So it's often done with convertible loans rather than with equity, again, because of the flexibility. What are the terms? It has an interest. So I give you the money now, and whenever we convert it to shares, we don't just count the money that I'm giving you now. We count that money plus some interest. It has some maturity, like after 18 months, you have to pay me back, although it never happens. Or if it's well written, it will also say, or you convert it into equity in these conditions. By the way, I've seen convertible notes of 1 page and of 20 pages. And believe it or not, the ones of 20 pages were much better and contemplated many more circumstances. So it can be tricky. The discount is important, is the decrease in the share price that you will have compared to the next investors. So if the next investors are investing at a 5 million valuation, you say like, okay, that's very funny, but I put my money a year ago. So I'm going to convert at a lower valuation. So when you calculate the number of shares that I have to receive, I will receive more. Like I'm buying shares at a lower value. So I'm receiving more shares. And the guy that is investing now will receive more expensive shares. And this is what you negotiate. It makes sense. You put the money earlier on. However, there is a cap of the valuation and a floor of the valuation. I give you money now. You will convert it in the next round. But now your valuation is huge. Okay. Still, you convert it at a 7 million valuation maximum. Because I put my money last year when there was a lot of risk. Not now. And the opposite with the floor. Again, this, I'm going fast deliberately. But because I really want like some concepts and some ideas for you to grasp, although of course it's not the whole story. This is what a healthy cap table could look like. Like, don't worry if you guys have like 3% less at some point or whatever, but this would be a fully diluted cap table. Like when they incorporate, the founders have 100. Maybe in the seed, they already create a 10% pool and they give 15% to the new investors. In Series A, maybe they have 50%. And so on. If the company is like really huge IPO, like it went public to a stock market, maybe to have 5%, it means to have 500 million. So here, like you wouldn't be like too unmotivated. So this is more or less what you guys should have. If in seed you have 30%, you should not follow the VC route, the VC path, because it's not going to work. So each round count on more or less getting diluted 20%. 20% is like a rule of thumb in the business. If you guys have like everyone wants to invest in your company, maybe you can give away 10 to 15. If you guys are having a hard time or want to raise too much money for what would be logical, maybe it's 25, 30. But keep more or less these numbers in mind for each round. So, okay, I hope we now have vocabulary, concepts, and terms that like became more familiar, and it sounded very weird at the beginning. So, like, okay, fine, we're negotiating here. Like, how does the negotiation process look like, and what are the documents that will help us navigate it? So at the beginning, first time, by the way, you should always try to have a warm intro with a VC rather than a cold, hi, I am whoever. And sorry, I'm kind of congested. And yeah, like you should try with a warm intro, and they will ask you for the deck, the business plan, and the cap table. Usually, my advice is don't send an NDA to a venture capital firm. They live off that. It's like banks. They live off like seeing companies' numbers. So I think it looks a bit amateur. It's not the end of the world, but usually they wouldn't sign an NDA. Maybe you guys have seen it, and that's totally fine. But in my opinion, I wouldn't do it. Try to get a warm intro. Try to talk to them. You guys would have many interviews if they are interested. It's pretty good news. And at some point, they may say, we'll send you a term sheet. A term sheet is one pager. We'll see an example later. A one pager, more or less, that says, this is the valuation, this is the phantom shares. This is like very, just like one page on these are the terms. It is non-binding, but these are the terms that we would be interested in. They send it to you, you sign, it's not binding, and then it starts due diligence, when they will like truly analyze your company while they start drafting the shareholders agreement. The shareholders agreement is what will happen after. It details the details of the funding round, but also will regulate how to handle the company afterwards and the economical and political rights afterwards. So a term sheet, it's a letter of intent. It's simply like, we would be happy with this, sign it if you also would be happy with this. Not much more. Term sheets may have different binding terms. It's not something standardized at all, but they are similar to each other, and there are many templates out there. If they send you a term sheet, they want to invest. We have seen cases, but like very, very, very few. Well, in fact, not among clients. I know of cases in which they signed the term sheet and then the round wasn't finalized. But I know it happened at COVID, like when COVID and stuff like that, but it's not common at all. So like special circumstances. But, or if they see something in the due diligence, that is the end of the world. Like the term sheet, you guys can already think like, okay, this is looking good. Something like this is a term sheet, the Y Combinator template that I found. The name of the company, the investment amount, the valuation, post money, they like underline it here. Option pool, this is the phantom shares or the stock options. Liquidation preference, whole other story. This is on the economical rights. Don't have time for that. Voting rights, drag along, like if the majority wants to sell, everyone needs to sell. Board members, okay, we invest, but we will have one member in the board, and stuff like that. As you can see, it can be a one-pager. You sign it, things are going well, and it may end well. Then, like, the valuation may change a bit. Yes, it may change a bit. But these are the general terms of the investment. And what is the shareholders agreement? The shareholders agreement is a so much more painful document that it can be tens of pages that has like all the possible conflicts, all the management of the company, everything that relates to the shareholder agreement that you guys are making with that investment. It is a private document, and it is usually dynamic. In each funding round, new people will want new terms. Clause types, and I'm not going to go into detail, but of course there are so many. Of course, valuation, share type, secondary sales, and what regulates stock options. Protection, like if things go bad, I'm going to keep this percentage of the economical rights of blah, blah, blah. How to govern the company, board of directors, shareholders meeting, the managers, the right of the CEO to get in debt, the right of the CEO to hire senior people, stuff like that. And exits. If there's an exit of the company, if there's a successful sale, what happens and what are the rights of each one involved. Again, that's tens of pages. I've seen 60 pages here, and it's huge. Those are the documents, but like, how is the process between the term sheet and the shareholders agreement? The due diligence. If you guys are just starting, if it's your first funding round, there's a bit on that. There's a bit of due diligence. A lawyer will tell you, give me all the contracts, give me the deeds, give me whatever, the financial guys. Like maybe the fund does it itself, especially with the financial part. Like send me your numbers, your past number, your invoices, like cash statements that show me that you had the cash you claim you had, a forecast, whatever. On the product, very often, also, well, I think here it's easy. Yeah, finance, legal and labor. By the way, when I said labor, when I said legal, I also imply like, do you guys have like any trial? Do you guys have like employees like requesting whatever? Do you guys have like IP problems? Like, no, my intellectual property, we have licensed this product, whatever. The product, and this, I recently talked to some guys that do due diligence in product for VCs. It's like, is this technology legit? Essentially, like, does it make sense? Is it truly a different than other companies? And there are also people that do team due diligence. This guy that is 20 years old and never even finished a high school, like, will be able to handle a team of 500 people? I think it's a legit question. So that's like where some people can say, like, I interviewed him and I think yes, but you need to coach him in this, this, and that, for example. Or do these guys truly know about their business? Do they get along? If they are more than one founder, like, will this explode because of that? This type of stuff. So if you guys are very shady during the due diligence, maybe the due diligence ends up in, we are not investing. So collaborate. Those guys are your future partners. If they send you the term sheet, they're not going to end up like, I'm not interested. They are interested. Only if something goes truly wrong, they wouldn't invest. And that can be on you, to be honest. So VCs typically count on third-party providers. In fact, we also do due diligence on legal and financial for VCs. And usually, if they end up investing, which again, it's usually the case, the cost is paid by the startup. But now they have money from the investors. Imagine 1 month, this part of the process, and then they should decide on, okay, let's go to the notary. The due diligence went well. We saw these yellow flags that, like, we want to clarify. We saw these green flags. Let's go. If there are red flags, maybe not. So, well, I don't know if you guys have any questions on the content. I know it was fast, a lot to cover, but again, I think like all the keywords that you guys will hear during the fundraising process were here. So certainly, and again, please text me, please write on the chat, count on us for any help on this. And I wanted to tell you a bit on the Startup Academy. As we explained in the course, a good strategy is always to cross-sell, and this is more or less what I'm doing now. Hold on, I see a question in the chat. Best book suggested? That's a very good question. On this particular topic, I suggest Venture Deals. I'll write it here. I'll write it in the public chat. Venture Deals. Venture Deals, to me, is the best book on this type of terms. In startups in general, the Lean Startup, I always recommend it. But in terms, Venture Deals is the way to go. So on our course on startup finance, it tries to explain everything that you need to know to understand the finance part of a startup. So it is fully online. It takes 10 weeks, but then you guys have lifetime access to the materials. In fact, you have access to the materials since the very beginning and forever. So some people like then wait until Christmas to have more time to review everything. You guys can count on us to text us or whatever anytime before and after and during the course. So that's totally fine. We estimate around 3 hours per week of dedication, although many people, I must say, dedicate 1, which is the live session. So for every lesson, you guys will have, for the 10 weeks, 10 lessons. Each of them, we have like around 1 hour of pre-recorded theory, very similar to what I just explained with me explaining the topics. A case that probably takes 1 hour to solve and to review. You guys have the quantitative part and the qualitative part, but we will only count the qualitative part. And then 1 hour live session in which we will review the case. So many people only connect to the 1 hour live sessions, and that's totally fine to get the certificate. Fully online, like I said, language in English. The price for 1,450 euros, 1,450 euros. In fact, if you guys, my colleague Dome just shared info on the course, and a bit before, she mentioned the Typeform link in which you guys can apply, and you guys would have a 15% discount if you if you join today, if you just sign up today, if you sign up today, it doesn't mean you are doing it. It means that you guys are pre-registered. Then we will review your application, and if we accept you, you guys would have the 15% discount. Talk to the sales team, because I think there's some timing involved on this and some term to get the discount. Objective: to master the tools in startup finance and do business models, financing alternatives, funding rounds, reporting models, and of course the network itself. We have already had almost 500 students, and we have had really great people. So we have introductory lessons on startup finance, then business models in detail, how the SaaS works, platform e-commerces, other business models work in very detail, all of them with the right KPIs, with the benchmarks in all of them and their nuances, startup reporting, and then more on how to fund a startup, funding alternatives. These 3 lessons, funding rounds 1, 2, and 3, 1, 2, and startup governance, are more or less what I tried to condense in this hour, but we would have like all the theory and all the live sessions, obviously, like in much more detail. And then another lesson on introduction to venture capital, to understand the other side. So on the teachers, it's between me and other people from our team. And also we have Jordi Vidal from 𝗘𝗏𝗀 as a guest, and Luis Ferrobledo as well as guest. So we hope that that it's also like people that have been working with startups a lot. There's like some pre-reads, there's the theory videos, the slides, and then the case statement, the solution, and then the live session. I think the live sessions are the coolest part, and we record them as well. So if you guys can't join, it's usually on Thursday afternoon. If you guys can join, well, Thursday 5:30, same time on this session, you guys can watch it later. So I would say, if you guys are interested, pre-register with the link that Dome shared. If you ever, like, if we tell you your application is accepted, then you guys register and you would have a discount. And happy to meet you there. So hope you enjoyed, guys. It's already 6:30. Again, text us for anything you guys may need, academy@𝗧cfo.com or Jaime@𝗧cfo.com. And yeah, hope to see you soon in future content or in our course. See you guys. Bye-bye.